We're here in Monte Carlo for the Rendezvous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Carsten Prussog, who's CEO Northern Europe for Munich Re. Carsten, welcome.
Hello, Richard. It's great to see you again. It's a pleasure to be with you.
It's great to have you. Thank you very much indeed. So we are here in Monte Carlo, where lots of discussion about the reinsurance market, the availability and the sources of reinsurance capital. What's the message that Munich Re is bringing this year?
Well, if you look at the supply side, you have two key components on the capital side, which is the traditional reinsurance capital and then the alternative market. On the traditional reinsurance capital, the number, actually AM Best just put out in their research, is around 515 billion, quite significantly up from 470 billion last year. And we expect it to stabilize on this level because there's still some unrealized losses in the books sitting, which have to be absorbed going forward. This capital is predominantly produced within the industry, so no really new and fresh capital flowing into the market, let alone something which we have experienced a couple of decades back, like a new class of reinsurers. On the alternative capital side, we see a volume of roughly 105 to 110 billion. It grew a little bit, but less than the accrual of the interest, so we don't expect it to have a major impact. Now, this is the supply side, but also the demand side is growing, given inflation, given higher values, and some growth. We as Munich Re are extremely well positioned to bring our proposition as a reliable and consistent partner to the market, and we continue to be able to put out significant capacities, even in difficult times with a very strong balance sheet.
So you talked a little bit there about the investor attitude, the investor appetite. Tell us what investors are looking for in the reinsurance market and how well reinsurers are able to provide that.
That's a very, very good question, Richard, and very topical, because if you recall, the years 2017 to 2022 were all but great years for the sector. So 4 years out of 6, the reinsurance sector failed to meet the cost of capital. And together with the geopolitical and macroeconomic changes in 2022, there was a significant shift beginning in 1/1/23, where prices went up and terms and conditions were renegotiated. Now, all this given, 2023 was a year where the reinsurance sector earned the cost of capital quite comfortably. However, one swallow doesn't make a summer, and also there are alternative asset classes for investors. So coming back to what I said earlier, that we have not seen any significant fresh money coming to the market. Perhaps one last remark, if you look at the Munich Re stock, which enjoyed quite a demand over the past years, we had the privilege that investors liked this, so the total shareholder return actually outperformed the industry quite well. I think it demonstrates that we are very focused on the right risk-taking and putting out risk-adequate prices, and are willing to walk away even if the risk is not adequate for us.
So in these sorts of market conditions, to what extent are reinsurers able to provide the solutions that insurers are looking for?
I think that's a very interesting question indeed. What we have seen since 1/1/23, since the beginning of a correction of the market, is that the risk appetite of reinsurers changed, and some of the demands of the primary insurers could not be met. That's why not only prices went up, but also structures changed. So retention levels went up significantly because there had to be a more balanced alignment between the risk-taking between the primary and the reinsurance industry. So it will be seen in how far there is capacity specifically to serve primary insurers to take out volatility out of their P&L.
And is that something that the reinsurance industry is prepared for at the moment? It seems that, like you say, they're moving up the ladder, as it were.
Also, very, very good question. I think if you look at the amount of natural disasters, over the past 4 years, it was above 100 billion, which is significantly above the average over the last 2 decades. So it's more a norm, and a significant portion of this was picked up by the reinsurance industry. So also the capacity we as reinsurers have put out has increased significantly over the past years. So overall, the amount of natural catastrophes go up, frequency and severity, predominantly driven by non-peak perils, so not the hurricanes and earthquakes, but more climate-driven events like flooding, severe convective storms, wildfires. And now it's a more balanced sharing between the primary and the reinsurance industry.
So we're here in what is generally considered to be a hard market. Tell us a bit about some of the drivers of change, not just of market conditions, but of the reinsurance industry generally.
Well, what we have experienced over the past decades is that there may be some more massive changes, specifically if capital markets get more complex, as we have seen in 2022, or if there are extraordinary events, accumulations of events, 30, 50 billion plus for the industry. And aside of these more disruptional changes, there are of course more gradual changes. One is technology, which impacts the whole industry with Gen AI kicking in, data analytics, etc., but also the adaptation of the modeling for assessing risks adequately because of the increased frequency and severity of these non-peak perils. We have to continuously adapt our models. That's what we as Munich do continuously, to bring the best knowledge to our clients and assess the risks adequately.
Carsten, thank you very much indeed for joining us.
Thanks, Richard. It was a pleasure. Thank you.
For AM Best TV, I'm Richard Banks.